Loans for bad credit. And why they qualify. Loans for bad credit are designed for individuals with low credit scores due to past financial difficulties, defaults, or other issues that reflect negatively on their credit history. These loans are typically accessible to borrowers with lower credit scores, but they often come with higher interest rates and less favorable terms to mitigate the lender's risk. In today's video, we have a detailed list of loans for bad credit, explanations for why they qualify, and what makes them suitable for borrowers with poor credit. Here are the types of loans we will cover. 1. Secured loans. 2. Unsecured loans. 3. Co-signed loans. 4. Subprime loans. 5. Credit builder loans. 6. Payday loans. 7. Installment loans. Don't forget to check out the description area of this video for a loan option that might be right for you. Let's delve in. 1. Secured loans. Secured loans require collateral, providing a security guarantee to the lender in case the borrower defaults. This additional security reduces the lender's risk, making these loans more accessible to those with bad credit. Examples of secured loans are A. Home equity loans or lines of credit, HELOCs. Why they qualify? Homeowners can use the equity in their property as collateral. Because a tangible asset backs the loan, lenders are more willing to provide funds even if the borrower has a low credit score. These loans typically have lower interest rates due to the reduced risk. Considerations. If you default, the lender can foreclose on your home. Additionally, these loans often have fees associated with appraisals and closing costs. B. Auto title loans. Why they qualify? Borrowers use their vehicle as collateral. The lender can seize the vehicle if you fail to repay the loan, lowering their risk. Considerations. These loans often have high interest rates, and defaulting could result in losing your vehicle. C. Savings secured loans. Why they qualify? The loan is secured by a savings account or certificate of deposit, CD. The lender can claim the savings or CD if you default. Considerations. Interest rates tend to be lower, but you need sufficient savings to use as collateral. 2. Unsecured loans. Unsecured loans don't require collateral but usually have higher interest rates and more stringent terms due to the increased risk to the lender. Examples of unsecured loans are A. Traditional personal loans. Why? They qualify. Lenders who specialize in bad credit loans offer personal loans without requiring collateral. These loans often have high interest rates and fees to compensate for the risk. Considerations. While easier to obtain without collateral, the higher rates can make repayment more challenging. B. Credit union loans. Why? They qualify. Credit unions are non-profit organizations that often provide loans to their members at lower rates than traditional banks. They may consider other factors besides credit score when assessing a borrower's creditworthiness. Considerations. Membership is usually required, and credit unions might be more flexible with loan terms. C. Peer-to-peer loans. Why they qualify? Online platforms connect individual borrowers with individual lenders. They might be more flexible in considering bad credit borrowers, focusing on other factors like income or employment. Considerations. Interest rates can vary widely, and platform fees might apply. See the description area of this video for an example of a personal loan option that might be right for you. 3. Co-signed loans. A co-signed loan involves a co-signer with good credit who agrees to take responsibility if the borrower defaults. This reduces the lender's risk, increasing the likelihood of loan approval. Why they qualify? The co-signer's good credit serves as a form of collateral, assuring the lender that someone with a good credit history will cover the loan if necessary. Considerations. The co-signer is legally responsible for the loan, which can strain relationships if the primary borrower fails to repay. 4. Subprime loans. Subprime lenders specialize in providing loans to borrowers with bad credit. These loans typically come with higher interest rates and fees to offset the increased risk. Why they qualify? Subprime lenders focus on borrowers with low credit scores and have business models designed to manage the risk. When approving loans, they may consider additional factors, like income and employment stability. Considerations. These loans often have high interest rates, additional fees, and strict terms. Due to their cost, they can exacerbate financial difficulties if not managed carefully. 5. Credit Builder Loans. Credit Builder loans are intended to help borrowers improve their credit scores. They require you to make regular payments into a savings account, with the loan amount released to you at the end of the loan term. Why they qualify? These loans don't require a high credit score, as they are structured to build credit. Lenders hold the loan amount in a savings account or CD, reducing their risk. Considerations. While beneficial for credit building, they are usually for smaller amounts and take time to improve credit scores. 6. Payday loans. Payday loans are short-term, high-interest loans intended to be repaid on your next payday. They are often accessible to those with bad credit, but carry significant risks. Why they qualify? These loans don't require a credit check, making them accessible to borrowers with bad credit. The short-term nature and high fees make them attractive to lenders willing to take on more risk. Considerations. Payday loans have extremely high interest rates and fees, leading to a cycle of debt for many borrowers. They should be approached with caution. 7. Installment loans. Installment loans are personal loans with a fixed repayment schedule and consistent monthly payments. They are often marketed to people with bad credit. Why they qualify? Lenders offer installment loans with flexible terms and conditions to cater to borrowers with bad credit. These loans often come with higher interest rates to offset the risk. Considerations. While more manageable than payday loans, they can still have high costs due to interest rates and fees. Summary. These are the main types of loans for people with bad credit. When choosing a loan, it's important to compare options, understand the risks, and consider the total cost of the loan, including interest and fees. Always be wary of predatory practices and aim to use loans responsibly to avoid further financial difficulties.